Yeah, the blur in the background's good.
I'm sorry?
It's good.
You're good, Jess.
Looks good.
Okay.
All right. Oh, there's like a little delay on YouTube. That's weird. Okay. All right. So, hey, everybody. We're live. We're getting started, everybody. Welcome to the Home Buying 101 webinar. We decided to do this one kind of, can y'all hear that?
Mm-hmm.
Y'all can hear me that talking?
Yeah, I can hear
that. I can hear that.
You probably need to mute your participant.
No. I'm trying to do this. Go downstairs for right now.
Okay, there's like a delay on. I can hear the recording on my end after what I say.
Oh, we can't hear that.
Oh, I can't hear it. Okay, good. No. I think I can get through it. But hey, everybody. So we're live, and we decided to do the Home Buying 101 webinar on here on Zoom to try and make it convenient for a lot of people. I know some people couldn't really get out, and we got COVID and all that stuff going on. So I have here with me today Ms. Jessica Compton. She is the owner and founder of Sky Credit Consultants. She's like the credit restoration guru. Anytime you come talk to me and you might need credit restoration, she's the one I'm going to refer you to. She knows what she's doing. She's going to educate you about the credit piece to make sure you know how to restore and to maintain a healthy credit score and history. And her services are very, very affordable. So hopefully after this webinar, you guys will find the information that we're giving very helpful, and you'll be ready and empowered to move forward with the home buying process if that's what you're desiring in 2022. So after her will be Christina Parks, very lovely Christina Parks with Service First Mortgage. She's going to talk about the lending piece, what that looks like when you guys are ready to apply for a mortgage. After you've passed the credit restoration test, you'll talk with Christina and she'll look at your credit and she'll tell you kind of what she's seeing, and if a little work needs to be done, she'll kind of give you some tips or a plan to get you moving forward with the home buying process. And then after her, of course, you'll come see me and we'll start shopping for homes. So without further ado, we'll get started with Jessica Compton with Sky Credit Consultants, and she'll go over the credit piece. Jessica?
Good morning, everyone. Can you hear me okay? My name is Jessica Compton. I am the owner of Sky Credit, again, like LaShonda said. I help restore, rebuild, and establish the credit by also educating you throughout the process to prepare for home ownership, which my services are really affordable, and I do it to be fair with everyone, because I was at one a credit of 170 point. I was able to maintain and repair my credit within a year's time, and I was able to get my credit score up to the 735 mark by maintaining and able to walk off for a dealership with a 2019 Mercedes-Benz. I was on and off of the lot in about 21 minutes tops. And I came from a background where I wasn't taught the importance of credit coming in. More so a generational curse is what I call it. So we have to empower ourselves of how to maintain and establish it first and foremost. The main thing that I would say is I will go over first and foremost the breakdown of what makes up a credit score. the payment history is the number one hotspot for the credit piece, and it's 35% of your credit score. So the way you make your payments is very imperative, especially in the rebuild stage. So you need to make your payments on time so that you can gain that healthy credit score and get the most points out of it, as well as the usage, maintaining a good payment history, as well as keeping your balances low. What I mean by that, the ultimate goal is to keep the balances on your credit cards below 30%. If you can keep it between the 1% and 5% mark, you're doing really good. Okay. It's not saying that you can't make purchases on your credit cards, but try to make those payments on the credit cards by the statement date. So you would want to get with your creditor to see when the statement date is, and you can also look on the bill. It says the statement date. Don't necessarily go by the due date. It's a method to the madness, is what I would say. Also, the length of credit is 15% of the credit score. What I mean by the length of the credit is sometimes you have credit cards that's like 15 years old, 20 years old. Every time you obtain a new credit card or line of credit, it takes the overall length of credit down. So if you had a credit card for 10 years and you go to apply and you were approved for a line of credit, so now your 10 years length of credit would go down based off of the average credit length, okay? So that makes up 15% of the credit score. The amount of new debt is 10%. So whenever you add a new line of credit, you see sometimes where your credit score would drop. When your credit scores drops because you're adding a new line of credit, that's absolutely normal. It's nothing to be alerted on. Just if you are in the credit repair phase, you would also want to get with your creditor, that's whoever's working on your credit, to ensure that it's a good timing to do so, because that could make or break a deal when it comes to the approval on a home ownership. Okay, so sometimes when you are in the credit repair stage, it's imperative that you have new lines of credit, and that's fine. It'll dip one month, and then the next month it'll go back up. Okay, so credit mix is 10%. You always want to have two revolving lines of credit to one installment loan when you're applying. So a revolving line of credit is something like, are you there? A revolving line of credit is something like a credit card, to where your payments, you get billed monthly, and your payments could be different monthly. An installment loan is something like a personal loan, a car loan, to where your payments will be the same every month. That's what an installment loan. So if your credit is not where it needs to be, and you don't have a high enough credit score, it's okay to start with the secured line of credit, which means it's backed by a cash deposit. You'll put approximately anywhere from $200 down to $1,000 down on that secured line of credit, and you're basically paying yourself back over a period of time. So the goal is, I tell my clients, is to make small purchases and turn around and make those payments before the statement date is up there. And so then you'll start seeing where your credit bills and your credit scores will start going up. So all while establishing and maintaining your credit, while I'm working on that, you want to establish and build that credit so that the scores go up. And so other than that, does anybody have any questions as of right now of how that piece works? The main thing I'm saying is that if you do sign up with my program, I just ask my clients to get with me before they open up lines of credit, making sure they make their payments on time, while keeping their balances low. Everything that's on your credit that's negative is not necessarily grounds for removal. Some things that's on your credit profile actually help your credit scores, believe it or not, that's negative. based off of the length of the debt, the age of the debt. So that's why I utilize a systematic approach whenever I do the credit restoration, so that it's in turn helping you out when it comes to purchasing that home. I also tell my clients not to make huge purchases while you are in the credit restoration stage, just because it could affect you when it comes to the approval and your debt to income whenever you're trying to close on that home that you're getting. And so I think that's a mouthful there that I gave. Is there any questions right now? Does anyone have any questions?
Any questions? Nobody's put anything in the chat. If you do have any questions, I forgot to mention, if you do have any questions, feel free to drop them in the chat box, the message box there. And then we'll answer them as we, get breaks in between. But no, I think that was great. I think that was a great kind of high level overview of what credit restoration is. A lot of good gems you dropped really quickly that a lot of people don't know, as far as how each piece of credit affects, your credit score. And I think you briefly went over that kind of, your payments versus the history, things like that. That's how your credit score is established, with different pieces of the puzzle, like that. So right. I think that's awesome. So we'll use that to go ahead and activate Miss Christina Parks. Once you've passed the credit restoration piece and you do your part and complete the program with Jessica, she'll, graduate you over to Christina, and Christina will, take your application and have you, she'll run a credit check on you to see what your credit score is. And then also, can you talk about, Christina, when you get on, can you talk about what you see when you have someone come in and they've gone through credit restoration, and you see that they're actively in credit restoration, but there are a few disputes on that. Can you touch on that?
Mm-hmm. So good morning, everyone. Welcome. Thanks for attending. I'm Christina Parks with Service First Mortgage, and I'll show you the mortgage stuff that I kind of prepared for you in just a second. But what LaShonda's talking about goes hand in hand. So sometimes I'll get a client first and pull their credit and look at it. And if it's something that I can say, oh, if you pay this card down, your score will go 20 points higher, and that's where we need to be, then we'll have that conversation. But sometimes it's beyond my ability to help. And in that case, I always send them to Jessica, because she knows what I need on my side, because one credit restoration person is not like the other. And I trust Jessica. She does what she's like. She knows what needs to happen on the mortgage side. She knows the stuff that we look at on the mortgage side that really helps the client to get the credit restoration piece taken care of, and it enhances your ability to purchase a home. So I send people to Jessica. LaShonda, Jessica, and I kind of formed this group a couple of years ago, and we've helped so many people get through this. And the dispute part that LaShonda is talking about is a little kind of, maybe Jessica can kind of speak to this a little bit more and make sure I'm fact check on this one. But when I first started a mortgage, people were just disputing everything on there. If it was a derogatory collection account, people were just disputing things. And all a dispute really is a pause on your credit for that creditor to go back and look to make sure that it actually is your debt, because they are obligated to remove debts that are not yours. So what a lot of credit repair people do, and you notice I said repair, not restoration, because I like the fact that we were calling Jessica restoration, because she actually is legit in True Blue. So credit repair, and it might work for some, but for mortgage purposes, disputing a bunch of collection accounts actually hinders your ability to purchase, because if the cumulative amount of non-medical disputed collections, or any derogatory, so charge-offs even included in that, non-medical derogatory credit, if there's over $2,000 cumulative that's been disputed, I'm going to have you remove those disputes, because that's a guideline on our end for mortgage financing. So that ruling is across the board, no matter who you talk to, no matter what lender you talk to, if there's over $2,000 cumulative non-medical collection or derogatory debt that's been disputed, we have to have those disputes taken off. And Jessica can probably attest to this. If it's a relatively new dispute, it will drop your credit score when we remove it. Now, if it's from 5 years ago and I tell you have to remove it, it's probably not going to tank your credit score. But all a dispute does is pause it for you guys or for the creditor to go back and make sure that it's your debt. So if it's really legitimately your debt and it wasn't a case of identity theft or a mistake on the creditor's part, it shouldn't be disputed. It's your debt. You have to own it. So that's the one thing I can say about disputes. I mean, in some situations, it actually does need to be disputed. They collected the money already and they're still billing you. That's a disputable reason. Think about it as what's the reason you're disputing something? If it's legitimately yours, it shouldn't be disputed. But if you actually made the payment on time and they're saying it's late, then it's a disputable offense. So just kind of throw that out there because that is something that that's one of the reasons why I trust Jessica so much is that she understands exactly what that means. She understands that you don't just dispute a bunch of stuff because you want to see if it falls off. Because in this lending atmosphere, things are not falling off your credit anymore. Now, 5 years ago, it was a little bit different story, but now it's not. And yet a lot of credit repair people will still try that as their first line offense. And it doesn't work. So if you're talking to a credit repair person and they say dispute, then hang up the phone and call Jessica because she'll do it right. How's that? That cover what you needed, LaShonda? I think she's on the other line.
Perfect. That sounds good, Christina.
Do you like
that's
that?
that's what I was saying that. And then while you're saying that about the disputing, I want to go ahead and really quick say something about what we call a dunning process. Where the client has it all in their hands right at one time. So what a dunning process is that these creditors or collectors, they will send out what they call like statements or bills. And it'll say you have 30 days to reply, or you're stating that the debt is pretty much yours. Like you're agreeing to the debt if you don't reply within 30 days. So that's very imperative, especially if you are in the credit repair phase. Whenever we start disputing these accounts with different collectors, it opens up room for other collectors to see that you are, trying to better yourself and get your credit scores where they need to be. So you'll start seeing these credit accounts come out of the grave and show up out of the grave, and then they'll try to put that on you. So that's another ding to your credit score. So it's very imperative that you check your mail, you open up these letters, because really you have your credit score in your hand right there. Because if you don't reply within that 30-day time mark, or whoever's working on your credit, then there's another hit to your credit. So it prolongs and it holds off the process.
That's great info. Great info. And yes, Christina, you hit that right on the head. That's exactly what I was looking for. Thank you.
No problem. Okay, so we want to talk a little bit about mortgage stuff. And if there's any questions that come up or anything in the chat or whatever, just let me know, or we can stop, go over stuff. Okay. Can everybody see my screen? A little bit?
Yes.
There you go. Okay. Now I have to move it in front of me because it went the other way. Too many screens on my part. Okay. So let's talk about just the overview of some loan programs. This is any of my borrowers that I get that are first-time buyers, I just kind of run through this with them so that they get an understanding of what basic mortgage looks like. There's 4 main loan programs: FHA, VA, USDA, and conventional. All of them have their own pros and cons. And so FHA is the first one I want to start off with. It's a great program. I love using it. I have an FHA loan myself. It is, I would say, a great first time loan program. Doesn't have to be, there's other options, but this is typically where we see our first timers head into. Minimum credit score 600. I know that there's some out there that might do 580. Just keep in mind, if you go down that route, you're going to need money in the bank. So they're going to want to see 6 months reserves in the bank or something like that. We can go over what that means. But for me, my lending 600 minimum credit score. And when I say minimum, there's 3 credit scores: Experian, Equifax, TransUnion. We take the middle score. And if there's 2 borrowers, then we take the lower of the 2 middle scores. So just keep that in mind. 3.5% minimum down payment. It has what's called an upfront mortgage fee of 1.75%. This is typically financed in. So that's part of your loan that goes into if you go buy a car and you finance the taxes, title, and insurance, or in fact, taxes, title, and registration. If you finance all that, it's a similar thing with mortgage. And then it has a 0.85 monthly mortgage insurance, and it's 0.8% if putting 10% down, or 0.80. That means that part of your monthly mortgage payment is got a mortgage insurance included. So if I tell you your mortgage payment is going to be $1,400 a month, then that will be principal and interest, insurance, homeowners insurance, homeowners insurance, and then property taxes and mortgage insurance. Pardon me. Principal and interest, homeowners insurance, property taxes, and monthly mortgage insurance. That's the 4 things that are in the mortgage payment. Mortgage insurance is for the life of the loan. This is one of the bad, I'd say the negatives or the cons as far as FHA housing goes, is that the mortgage insurance is for the life of the loan. So, if you've got $200 a month, part of your mortgage payment is monthly mortgage insurance, goes to FHA. This is what's backing your loan. So if $200 of it goes to the mortgage insurance, then that's $200. It's always going to be on your payment till you refinance or sell the house. Maximum debt to income ratio is 55.9%. So FHA is the most lenient as far as credit score threshold and debt to income threshold. Debt to income is calculated by whatever the new monthly mortgage payment is going to be, plus all of the debts that you have on your credit report that you're paying. And then we divide that by your monthly income. So that's how we come up with the ratio of 55.9% or below. The VA loans are specific to veterans or spouses of veterans. Even if grandpa was a veteran and he's not going to be on the loan, then we don't go with the VA. So it's specific to the borrower. Minimum 620 credit score. I have an asterisk by that because I'll cover that later, but just remember the 620 credit score. There is a funding fee on VA. You'll find this is a reoccurring theme on government loans. FHA, VA, USDA are all government loans. They all have some type of fee that is basically included in your loan amount. This is what's preventing the housing market to blow up again and fall apart. This is what basically this money and this money goes to FHA, VA, government, HUD, and this is what's funding basically the demise of 2009 when the housing market crashed. This is the way for them to prevent them going bankrupt. 0 down payment, that's attractive. So this is one reason why we love VA loans. Must meet residual income test. It doesn't have a debt to income like it does for FHA. It's a little bit more of a sliding scale. So there is a residual income test. It basically goes with how much money you make and if there's enough money left over for all of your debts and any maintenance on the property, stuff like that. There is a calculation that goes into that. Sorry, I keep clicking back. Conventional. Conventional is one that is, FHA and conventional are pretty much the most 2 common loan programs that anybody will do. Minimum credit score is 620. Once again, the asterisk. 3% down payment or 5% down payment. 3% is what we can do if you're a first-time home buyer. It's a little bit less than the FHA, which is 3.5%. 5% down payment if you've owned a home before that was a conventional or an FHA. If you had a home in the last 5 years or 3 years, then you'll have to do a 5% down payment. Now there is a caveat to this because in this current lending market, I'm not having as much success with the lower credit scores at only 3% down. So just kind of keep that in mind that, I want to do conventional loan. It's 3% down on a down payment and, it's better and it's cheaper or whatever. Sometimes it won't go. And by that, I mean automated underwriting. I can't get it to get an approval at 3% down. Sometimes you'll have to, in order to make conventional work, we'll have to go higher than 3% down. Sometimes it's closer to 5%. This is case by case basis. So it's a lot of information, just broad overview. Every person that I speak to, we dig in together and I show you all the different options you have. And then you can make a decision on which program you want to go into based on if it qualifies or not. Mortgage insurance, you do have mortgage insurance on a conventional loan. It is based on what the credit score is, what the debt to income is, and what the loan to value is. So that means how much you're putting down is the loan to value. So if it's 5% down, the loan to value is 95%. So the mortgage insurance is calculated based on that. It stays on the property until you have 20% equity. So that's that 20% down on conventional. If you put 20% down or more, you would not have mortgage insurance. Maximum debt to income on this is 49%. Once again, that's, if there's an approval. So this is why I'll start looking at conventional, and if it doesn't work, then I'll go FHA, typically. USDA is another government loan. It's a 620 minimum credit score. There is another 0 down payment on this one. Here we go with the 1% upfront fee and the 3.35 monthly. That's going to be the mortgage insurance, and the upfront fee is similar to what VA and USDA or FHA had. 43% max debt to income, and this is only available outside of city limits in certain areas. And there's also a max income limit per household. So if the program works, it's a great program. If it doesn't work, then we look at other options. Now, I just wanted to hone in on this asterisk that I had on these credit scores. If it's less than a 640 credit score, it's a very rare approval. The only way that we really get those approvals on those 3 programs under a 640 credit score is if there's pretty much a bunch of assets in the bank. They want to make sure that they're going to get paid, essentially how it works. So we look at every case by case basis. We look at it, see what works best, and then we give you the options. But those are the main credit or the loan programs. Let's talk about down payment assistance. This was a big topic that I talk about a lot. Most of my borrowers need some kind of an assistance. It's hard, especially when you're a first-time home buyer. Where is the money going to come from? Because it's expensive. How are you going to get into this home? We can do down payment assistance on all 4 of those loan programs. VA is with an exception. So it's a little bit of a different monster when we try to do it with a VA loan. Those are going to be case by case basis. A lot of times it's purchase price. So if it's over like a $300,000 purchase price, we can usually make it work. There's some program parameters around that. You can get an increment of 3%, 4%, or 5%. So the way that would work is you take the total loan amount times 3%, and that's how much money you get. I'll show you a slide here in a minute that explains what that looks like. Or you do it with 4%, or you do it with 5%. And people are like, why wouldn't you just get all 5%? So these are rate based. So 3% down today. I'll just keep talking and then find out what this is. So 3% down today, 4% down today, 5% down today, each have a different income or interest rate. So if you wanted the 3% down payment assistance on an FHA loan, today the interest rate's 3.75. If you wanted 4%, same scenario, FHA, it's 4% is their monthly interest rate. If you wanted the 5% down payment assistance, then the interest rate is 4.5%. So that's what your monthly mortgage payment is based on. So if you only get 3% of the money, but your interest rate is 3.3 or 3.75, your monthly mortgage payment is going to be less than if you took the 5%. We go through this on an individual basis when I talk to my clients. There's a grant versus a 3-year deferred forgivable loan. We look at how long you're going to be in the house. If you're going to be in the house for at least 3 years, then we look at the 3-year deferred forgivable loan because it's got better rates than the grant. If you're only wanting to buy it for 2 years and then, in 2 years, I want to purchase my next house, then we would look at the grant, a little bit higher interest rates. They're based on loan programs. So conventional rates are different than government rates. There's a minimum credit score of 620 to get this. So even though I can do an FHA loan for less credit score, if you want down payment assistance, this is where we're trying to hit. And honestly, anybody that I talk to, if we can get you to at least the 620 mark on your credit, it's going to be a much smoother sailing all the way through. There's less paperwork we have to get. There's less documentation that we have to do for different things and assets. So this is where I tell Jessica when we talk, this is kind of where I want to hit everybody, is at least a 620. If you have less than a 640 credit score, so anywhere between a 620 and a 639, then you do have an origination fee. This is through my down payment assistance program. They themselves charge it. This pays them specifically. So the way you calculate that is if it's $100,000 house, then you have 0.5% origination fee, then that 5%, 0.5 to 0.5%, $500 goes to the specific down payment assistance program. Conventional, you need a minimum of 640. How am I doing, LaShonda? Good, Jess? Any questions? We're good? Okay.
Nope, no questions yet. You're doing amazing.
Okay, well, we're just gonna keep going through. Okay, so here is a scenario with an FHA loan, 300,000 purchase price, and if getting 3% down payment assistance. So you're taking 3% of their money. The monthly mortgage payment on that looks to be about $23-22 a month. Principal and interest is $1,364. Homeowners insurance, we're just estimating $150. Property taxes, we're estimating about $575. This is that mortgage insurance. So on this particular scenario, $203 of this $2322 is always going to be part of this mortgage payment. Does not fall off. If it was a conventional loan, eventually it would fall off. So what I advise people is if we have to start with an FHA loan, keep your credit moving forward, keep your credit building, getting higher credit scores. And then in a couple of years, look at refinancing it into a rate and term refinancing out of an FHA into a conventional, and then we can drop this mortgage insurance and save you some money each month. This particular scenario has an HOA. $30 a month, I believe, is $500 a year. And so that would be, $360 a year. My calculation's off. So if your property that you're looking at has an HOA, a monthly or a yearly HOA fee, we divide that by 12 and we include it in the scenario because we need to make sure you qualify for it in the ratios. Now over here on the right, it says closing costs. To get into this $300,000 house, you're going to need to have $23,836. And that's a little bit high. So we'll just kind of overestimating just for the purpose of this. Now, if you want the down payment assistance, they're going to give you $8,836. That's 3%. Then earnest money, you've already put $3,000 down because earnest money is 1%. LaShonda will probably cover that with you. Option money, say $200. Once again, LaShonda will cover what that means. And then you're going to pay about $620 for the appraisal. So this is how much you need to bring to closing before we start adding credits back in. Down payment assistance give you a little bit of money. You've already put $3,000 in yourself. You've already put $200. You've already paid the appraisal. So we subtract all of these numbers from the $23,836, and you need to bring $11,180 to closing. That's out of pocket that you have to bring. I'll explain where that money can come from, just to give you some ideas. Now, this is the same thing without the down payment assistance. So without getting that money from the down payment assistance people, same monthly purchase price, all of this is the same. Closing cost is the same. Now here you've only put your earnest money, your option money, your appraisal money credited. So you need to bring the $18,426. You might notice this plus this does not equal this. The reason being is the actual down payment assistance program does have about a $1,500 fee attached to it. It is financed in. So they charge to get the money. Of course they do, right? Nothing's free. So they have to make sure that they make their money too, and they get what they need in order to give you. They basically loan it to you up front. It works out. None of this is actually money that you see, but I just like to point that out. It's not free money. There is costs included into it as far as like processing stuff like that. So I just want to point that out. Closing costs. So the closing costs cover the down payment, title fees, property tax escrow, homeowners insurance escrow, underwriting and processing fees, and the down payment assistant fees like I just talked about. So when I tell you you have to bring this much money to the table, it includes the down payment. So on this particular scenario, it was FHA loan, that's 3.5%. So 3.5% is part of this. Did that make sense? Jessica, are you listening? Okay, is that clear? Sometimes I talk about stuff that's just I get, and then everybody else is trying to catch up. So last slide that I want to show to you is assets. When we talk about where are you going to get the $11,000, where are you going to get the $18,000? Checking and savings. Some people are really good at saving. Say, every month they put 25 bucks aside, 50 bucks aside. They've been doing it for so long. Now they have this nice chunk of money. If you don't, I completely understand. I spend my money myself. So just, it's hard to save. Saving is hard. I saw something one day that said saving is hard. Well, it said being broke is hard, but so is saving. So you choose your hard, right? You choose which hard you want. Gift funds. If you have somebody who, grandma says, I want to help you with your first house, I'm going to go ahead and give you $10,000. That's completely acceptable. 401ks, they do have, most 401k programs have what's called a hardship loan or something similar to where if you're using it to purchase a house, you don't have as many penalties. So if that's something that you want to look into, definitely have that option. This is down payment assistance. In a different market, we could talk about seller concessions. I left it on here because it is an option. It's just not going to be found in this current market. That is what you would find if you were in a buyer's market. If there's houses that have been on the market for more than 6 months, then you're going to see sellers going, gosh, I need to get this much money out of my house. So if I sell it for an extra 5K, then maybe, I'll give the 5K back to the buyer or whatever. So we're not currently in that market. Hopefully we turn into that market soon because it makes my life and Jessica's life and LaShonda's life so much happier. It makes everybody just so much happier. But that's what I got for you guys. Let me know if you have any questions. I'm going to go back to the first slide and I'm going to have my my email address. And if you guys have any questions or want any follow-up, just let me know. I'm more than happy to help. And LaShonda, I'm going to let, I don't know how to.
You're gonna give it back to me.
There we go. I'm going to send it back your way.
Well, thank you.
Thank
you. That was awesome. I really hope everybody that's on here is really grasping and getting some really great information from what was shared. From Jessica telling you, what she looks at and how to get you back on track, restoring your credit history, your credit score, and then listening to Christina talk about what she needs your credit score to look like and your credit history to look like when you do go to her or any lender to apply for a mortgage. Of course, everything that Christina just went over is really another high level overview, and it's a case by case situation. So it's not very specific to any person. It's just, just a scenario driven example that she's giving, just so you guys can get an idea of what to expect when you are going to start the process. I think every lender is pretty much the same. I mean, they all just have their own parameters and, business partners that they work with. So she's not far off from what any other lender can do. So I hope you guys grasping nuggets from this. I don't see any questions yet, so I think we're good. So after you've met with Jessica and you finished the program, you did everything you're supposed to do, you understand how to maintain where she's gotten you to credit score wise, credit history wise, and you're applying that knowledge. And then you talk with Christina, who now has pulled your application, and she sees how amazing your credit history looks, how strong your score is, and how good you are at keeping your debt to income very, to a minimum. And she says, okay, I can, right now it looks like I can pre-qualify you based off of your specific situation for $300,000. And now you're ready to go shop for a house. At that point, that's when, you'll connect with your realtor. I will speak, and say, okay, you'll call me and we will start talking about what that looks like, that home that you want to purchase, where do you want to live, because that plays a big part in your ability to purchase. So just because you're approved for $300,000 doesn't mean you can probably go live in Mira Vista. You can't go live in Mira Vista for $300,000. So it just depends on where you want to live. It's to know how far that $300,000 will take you. So that's going to take me to my first point, which is kind of what the market is doing right now. Right now, the market is a seller's market. And for those of you who don't know what that means, seller's market, buyer's market. A seller's market is when sellers are able to list their house for top dollar plus some and get multiple offers or multiple buyers, battling, if you will, to purchase their house from them. So they'll list their house for one price, but at the end of the day, they'll sell it for, almost double what they listed it for. It's crazy right now. So with that being said, if you are not in a position where you have additional assets, savings that's readily available to you, family members that can, help you, get to the closing table with, cash by giving you a gift, or again, you don't have a 401k that you've been, adding to for years. Just because you're approved for that 300,000 doesn't mean we need to shop up to that dollar amount if you don't have the assets readily available to use to be able to be competitive in the market. So with it being a seller's market, you're going to need to keep in mind that just because they're listing it for $300,000 doesn't mean that, you should offer 300,000. Yeah, they're asking for 300,000, but in this market, with it being a seller's market, they're wanting you to pay more than that. That's just a suggested price. That's not saying, hey, this is how much my house is worth. This is saying, at minimum, I'll take this. And that's just, pretty straightforward. They're like, at minimum, I'll take this, but really in actuality, in the seller's market, we want more. We want more than what we're asking for. And we're gonna give the house to whoever is willing to pay that. So that's basically what a seller's market is. And that's what we're currently in, which is part of the reason the interest rates are pretty low. They might not stay there too long. So I did a live the other day where I talked about people saying, oh, I'm just going to wait until the house prices go down. I'm going to wait till the market, changes, or it's crazy. The house prices are not going down. The house prices will maybe stabilize eventually, but we won't see those great, house prices we had before. I know I see some people seeing $300,000-$400,000 houses that are only, maybe 2,500 square feet. And they're like, wow, I'm glad I bought my house already. Yeah, because right now, the houses just aren't what they were then, as far as what you get for what you pay. But that's just the reality that we're in. And I wish a lot of people really understood that. A lot of people think it's just people trying to persuade them to buy a house. It's like, no, if that's on your list, if that's on your goal list, then you definitely need to really consider, like, hey, can I afford a house right now? If the market is saying this is how much the houses cost, can I afford that? And if you're saying, yes, I can, but you're saying, I'm just going to wait to see if I can get it for a lesser price, then you're going to, potentially outprice yourself and not be able to be a homeowner. So keep that in mind whenever you're really deciding if you want to purchase a house. So when it comes to hiring a real estate agent, number one, I like to mention, it does not cost a buyer anything to use a real estate agent. We do not charge buyers to use our services, to hire us, even though you're hiring us. Essentially, it's a contract between you and I. You're saying, I am hiring LaShonda to help me find a house, to do her fiduciary duty, to make sure that I'm getting the best, deal possible. And we work together to make sure we can accomplish that. So when you hire a realtor as a buyer, you're essentially positioning yourself to be able to really be effective and competitive in a seller's market, because you go out there and if you don't know anything about real estate, then you're relying on that listing agent or that selling agent that has listed that house for sale. You're relying on them to help you essentially buy that house, because that seller's agent has a duty to their seller. They don't have a duty to you. They are under contract with that seller to sell that house for the top dollar and to do the very thing in that seller's interest to get that house sold in a certain amount of time. So if you go out there as a buyer, even with the new construction build, the builder is for the builder. The builder wants their money and they're not going to do anything extra to help you get the house. They're just going to do the bare minimum to get it sold. So if you go out there as a buyer and you're not represented by a real estate agent, you're really you're doing yourself a disservice thinking that you can go out there and do it, because there are contracts that you have to sign. And where are you going to get the paperwork from? Like I said, unless you know real estate, maybe you're in real estate before and you think you have it. Okay, fine. If you used to be a realtor, I understand, do it on your own. But you still have to figure out where to get the contract to write up your offer, or you have to rely on that listing agent to write up your offer. But is that real estate agent really going to advise you as a buyer, hey, you should offer this? No, they're not. They can't tell you what to offer, because then that would kind of be a conflict of interest for them to tell you, hey, offer this. Just think about it. Okay, I'm selling this house for Sarah, and then Bob comes over, he wants to buy it, but he's unrepresented by a realtor. How can I tell Bob what to offer when really I want I want to get top dollar for my seller? Like, it's not going to work. So just keep that in mind. Like I said, and even with new construction, the sales reps in there, they work for the builder. So they're not there to represent you. They're going to offer, bare minimum. And there is what am I trying to say? They have wiggle room basically to negotiate with you on those prices on those new construction homes. So, don't think that they don't have wiggle room. At the end of the day, if they sell that house for what they want for that house, that extra money that they're getting essentially goes to that sales rep as a commission. And what it is those sales reps don't want to eat into their commissions to help you get a good price on that house. So I won't dive too deep into that, but that's why a real estate agent, hiring a real estate agent as a buyer is very essential and will help you in the long run, get into that house that you want. I still don't see any questions just yet. So I'll keep going. So I also touched on before how 300,000 is the new 200,000, and Christina briefly touched on that as well. She kind of gave a scenario. So again, those numbers are just, for example purposes. Everybody's situation is different, because obviously the interest rates are going to change. They change constantly, daily, if not hourly, Christina. They change very often. So just because, like today, she talked about if you use a 3% interest rate, a 3% down payment assistance on a $300,000 house, your interest rate would be 3.75. Well, that doesn't mean that tomorrow, if you go apply with Service First, it's going to be 3.75, because it changes so often. I don't know why this thing just keeps blocking me out, but so keep that in mind. So when you see $300,000, just know, like, you really have an opportunity to get a really nice house for $300,000. That doesn't mean that there aren't any great houses under $300,000. It just limits the options that you have as far as the area, the type of house, and of course your mortgage payment. So keep that in mind. If you're thinking about buying a house, can you afford a house in the $300,000 range? Be honest with yourself. If you can't, then maybe right at this point you're outpriced in the housing market, and you're just going to have to sit back and just kind of re-strategize, maybe get apply for a raise or a better paying job that will position you to be able to afford a house within that $300,000 range. Again, it depends on the area, because there are some really nice houses that are actually new construction homes, but they're further south. So again, it just depends on the location. You can go to Alvarado and get a brand new Bloomfield home for $280,000 or $90,000. You can't do that here in Southwest Fort Worth or Crowley or Burleson. Right now, they're in $400,000. So it just, you have to really, like I said, sit back, strategize. Are you okay if you're working from home? Are you okay with, living in Alvarado, since you don't have to make that commute? If you are okay, maybe consider Alvarado or somewhere maybe far west or far north. They still have affordable homes out in, I think I was in Keller the other day, or Saginaw. They had some D.R. Horton homes that were under 300,000. Yeah, it's at the higher end of 200,000, but still, if you're trying to not go up to 300,000, then that may be an option if you're willing to negotiate on the area. And then the last thing I'll touch on is, when you do hire a real estate agent, there is paperwork that you have to fill out, because as a realtor, we have obligations to our broker where we have to supply documentation as to how we are affiliated with the transaction. And by doing that, we have to have the buyer sign a representation agreement, which says that, hey, I hired LaShonda to help me purchase a home, and she's going to help me from this date to this date. It does not mean that you're obligated to pay me anything. It doesn't mean that that we have to work together forever. And but that is a part of our agreement together, is for you to sign paperwork saying that you hired me to help you, because I do have to turn that in. Now you would contact me and add me to the transaction after you've talked to Jessica, after you talk to Christina. You would contact me and we would go over, you know, what you're looking for in a house. Sometimes, you know, people do contact me first and say, hey, I don't know what to do. Can you tell me how to get started? And we'll have, you know, 15, 30-minute conversation. And just based on that conversation, I'll be able to tell them, okay, you need to call Jessica. Here's her number or her email. Or, okay, well, let's go ahead and talk to Christina, and she'll be able to give you a game plan. If you're not quite ready, she'll either be able to give you a plan and say, okay, if you do this, then you're ready. Or she'll say, okay, yeah, you're not ready. Go ahead and contact Jessica, you know, at Sky Credit Consultants, and she'll be able to get you on track so that, you know, in 6 months to a year or whatever, depending on your situation, you'll be ready to buy a house, if, you know, if nothing drastically changes in your situation. So it's really no particular order where you can contact me. You can contact me just to have a consultation. But as far as when it's time to buy a house, it would go in order of, depending on your situation, Jessica, Christina, then me. If your credit is ready to go, you're very good with keeping your credit, you know, healthy and your numbers strong, then you wouldn't need to talk to Jessica. You would just go straight to Christina. And then within 24, 48 hours, she would have you pre-approved or pre-qualified to be able to go ahead and start shopping for a house. And then depending on what you're looking for, if you know what you're looking for, we can have you under contract within 30 to 45 days, closing in about 60 days. So it just depends. But that's pretty much how I get into the mix. Once you guys have decided you wanted to purchase a house and you've gotten your credit together and your financing in place, then we can just start shopping. That's the fun part. That's the part that takes the longest, though. But I don't see anybody. If you have any questions, feel free to put it in the chat. I don't see anybody's asking anything. So I think everybody may just be absorbing everything, writing stuff down, and just kind of soaking it all up. Did you guys have anything else you wanted to add, Jessica or Christina? No?
No.
I'm good.
Okay.
I'm good.
Okay, well, we're good to go then. I thought it was going to be longer than this, but we breezed through that one. It only took us about an hour to get through everything.
Yeah.
Okay. Well, if nobody has any questions, we will get up out of here. We will be doing another Home Buying 101, either seminar or webinar, just depends on, you know, what's going on out here in the world. I like doing this webinar. It was pretty cool. Didn't have to leave the house, and Cowboys about to come on, so I got to go put my cowboy gear on. Go Cowboys! But okay, everybody, thanks for attending. I appreciate everyone that was able to join the live, even those on YouTube. If you guys have any questions, feel free to reach out. I didn't put my information on here, but my number is 817-909-5118. Jessica, what's the best way to reach you?
Let me unmute myself. You could actually reach me at 817-606-9797. If you text me, I respond really quick through text because I have so many inquiries and consultations, even have a couple this weekend. You can follow me on Facebook at Sky Credit. Again, that's SKYY Credit Consultants. Follow me on Facebook and Instagram. And my website is www.skycredit.com. And again, that's SKYY. And I'm really interested to speaking with you. If I could be of assistance, don't hesitate to reach out. Other than that, I really appreciate you guys and ladies for joining us today. Thank you so much.
Thank you, Jess. Christina, what's the best way to reach you?
You can call me 817-507-7329 or kparksmortgage.com. That takes you to my website. When we're talking mortgage application, I do have an app that can be shared, so you can, do it on your phone. It's kind of cool. It has a calculator, so you can run scenarios and stuff like that on it. But if you want to have a personal conversation on the phone, you can call me too. Either way works for me.